Hi, hi guys. Today I want to show you how to use like options to do some option trading. Uh, so pretty so everyone knows how to trade Bitcoin like using OKX or Bitcoin Binance platform, or if you are in the US, you can use Coinbase, Binance US, right? To trade your spot trading, or someone use like they will buy like futures trading like in OKX or Binance. We have you know this kinds of like the futures trading, which is the perpetual uh futures trading. It's kind of like but today we are not going to talk about like futures trading. We are going to talk about options trading. So the main difference is between options trading and futures trading is that um, for futures trading, if you buy a futures contract and you have for example, if you buy a long positions, and then once the price was once the price is down pretty quickly or pretty fast, then you have the risks to be to have some like a liquidation problem. But as for options, if you have the long positions, if you have like a call, if you buy a call options, and you kind of like you have two results. So one result, once the price has gone up above your expiration, above your strike price, and then you are going to uh get some profit between the actual spot price and your strike price in your future in your options contract. But if the price was will not be over like your strike price in your options contract, you will lose your you know the options fee, which is like the premium of your options contract. So today we're going to so why we need to use options, especially for some like institutions investors, or like normal investors. uh so the reason is that using options can give you some some ability to combat risks. So if you hold some spot of Bitcoin or ETH, and you have no idea how in the short term or long term the price will go up or down, but in some way you can use like options to combat some like risks, like for example, if the price was down pretty quickly, you can buy put options uh to bet the price will be up or will be down. But if you predict like price will be up in the short term or long term, you can buy a call options and to bet the price will go up in the future. So I feel like compared to futures, you have like some risks to be liquidation if you're in the buy side of options. And the only thing you need to worry about is the cost of buying options. But you don't have to worry about like whether you will have like some liquidation problem once the price is totally against or is totally opposite to your predictions. So you don't have to execute your options once if that price is opposite to your prediction. So in some sense, options can enlarge your profits, and on the other hand, it can some way to help you to combat some risks. of liquidation, like compared to futures trading. You also, if you are doing futures trading, you probably will lose like your money once the price is pretty against your prediction. So if you predict like some Bitcoin or ETH will their price will go up in the futures, if so in that case you probably will buy a long positions. I don't know how much money you will put it, but once the price was totally against your prediction or is totally opposite your prediction, you will have like, if you don't have enough money to to combat the risks, you probably will have like some liquidation problem. So if you have like a 10 times leverage, once the price is pretty down, like 10 percentage, you will lose all the money in your long positions. But in option trading, you don't have to worry about. You don't have to worry about you will have like some liquidation problem, especially I mean if you are buy side, but if you're sell side, you have some liquidation problem. But in this video, we are only talking about if you are buy side in the option trading. So if you are not familiar with option trading, I recommend to read some material online. There's a tons of resource online to help you to understand the option trading. But in this case, I will tell you how to buy option trading or how to buy a call option or sell options in the OKX platform. I think it's quite similar in Coinbase or Binance or other kinds of like exchange center. But I think they are quite similar. So if you can understand this video and how to do actual option trading, you are quite familiar. You will find it's pretty easy to use other platforms to do option trading. Okay, so I'm not going to tell you what exactly options is. If you are not familiar with it, you can go. I recommend to check some like videos or like some resource to read how to do option trading. But in this case, I will show you like some technically how to do option trading in OKX platform. Okay, so if you open your exchange system, and then you will see a bunch of the options. If you click the trade over here, they have like several options for you to choose. Since we're going to do like option trading, so we need to click these options and then to choose like ETH USD options chain. I only use ETH to set up an examples. If you have but it's quite similar to the option trading for Bitcoin. So but actually in OKX the volatility no sorry the liquidity of option trading is pretty, compared to futures trading, it's not that you don't have like high volumes for you to do some option trading. So the liquidity is a problem in OKX right now for option trading. If you have like some other options like in Coinbase or Binance, I think their liquidity for option trading will be better than in OKX. So but anyway, as for the normal investor, I think it's quite I think it's totally enough for you to do option trading in this platform, because you don't need to do like high frequency trading for single investors or normal investors. You only need to, as for retailer investor, you only need to to do some kind of like an easy option trading right now. So I will use this OKX platform to do like some demonstration. Okay, let's check out this. Okay, so if you see this my page, and you will see a bunch of options. So in the left hand side, if you check this green part, it's the call option side. If you check the right hand side, it's the red blocks are representing the put options. So I'm going to demonstrate how to do option trading for call options. So the middle side is the strike price. It's like the strike price $3,000, $3,050, and $3,100, and so on and so forth. So for call options, if you click one, oh, by the way, the 3312, this number should represent the current ETH price, but it's kind of like a floating from time to time. So it's actually I think it's the median, or it's like average price for this options strike price. But you can see that it's pretty close. If it's pretty close to the actual spot price right now. So okay. So suppose our current spot price of ETH is $3,313, and we predict like, for example, 1 month later, and I'm going to predict like the price will be above like $3,500. So if you click this, and then if you see my right hand side, and you will see this block. And then, okay, let me explain this. So we have like several gray symbols we need to understand. So the first one is market implied volatility, which implies how historical spot price volatility will be based on the Black-Scholes options formula. So in most of the cases, some exchanges will use like Black-Scholes options formula to calculate the market implied volatility. It's pretty important symbol for our retailer investor to know, because for option trading, you most of the time don't trade like normal stock traders. They will predict like price go up and go down in the near future. But as for option trading, you pretty much, at most time, you're not bet the price will be above the strike price in the 1 month later or 2 months later. You pretty much like to bet, if you buy like some low level volatility, and then you probably will assume the volatility will be back to the mean or the average price of the historical volatility. So if you can, at some point, if you see the market implied volatility is pretty slow, like 30% or 40%, and if you buy at that time, based on the Vega, based on the options Vega, in options, the Vega represents the partial derivative of the call option with respect to volatility. Actually, the Vega's formula is same for call option and put option. So in some sense, so you can understand that you can assume that the Vega is always larger than 0, which means as the volatility is going up, presumably, or at least if other factors are fixed, at least based on the formula's calculation, and theoretically or approximately, the price of the call options and put options, their price will be up. It really depends on how large the Vega is. Okay, here is the thing. This Vega is ETH matrix. So it's not calculated by dollar. It's calculated by ETH matrix. So it's use ETH as its price matrix instead of the USD dollar. Okay, but theoretically they're the same. So this guy, this Vega is always zero, is always larger than zero. So you can understand that you can you only need to remember that since the Vega is always zero, for investors, if we buy some options contract at a very low level market implied volatility, if the market implied volatility will be go up in the near future, and we assume the price of call option or put option their price will be higher than current level. So if you can find that point, and it's a good way to invest it right now. If the market implied volatility is pretty high, and I don't think that's a good time to invest, unless the market implied volatility will be retreat to the lower level, and then in that time you can think about like buying, option trading. Okay. Let me explain the delta. The delta means the partial derivative of the call options with respect to the price of the spot price. So you can imagine that the delta means once the spot price is increased to $1, it's increased by $1, and the options price will be increased by approximately $0.3981. So it's kind of like, so for call options, the delta is always larger than zero. So theoretically it means once the call options, or once the spot price is go up by $1, and at the same time, theoretically, the price of the call option will be go up by $1 too. So it's a very important indicator for us to know. And you don't have to worry about gamma right now, but it tells us like how quickly the delta will be changed. So actually the gamma is a derivative of delta with respect to spot options. So it measures how quickly the delta will be changed as as the spot price changes. And the theta at the most times the theta is always smaller than zero. So theoretically it means no matter whether it's a call options or put options, and we can think that the price of the options will be decreasing. The price of the call options or put option will be decreasing as time goes by. So theoretically it means if you hold your options contract for a very long time, and as time goes by, your price of the options will be decreasing unless some situation will be happen in the near future, like either the price will dramatically go up, or either the price will dramatically be down. It's a pretty good, it's very important metric, especially if your options contract is pretty close to the strike date. You need to pay more attention to the theta metric, because the longer you are holding all the options, the less likelihood you will get profit at the end. So it's better for you either to throw them out and to sell them out, or you bet or you can bet like some huge market historical things will happen, or a huge like some price or volatility will be happening in the future. So anyway, I'm not going to talk about too much details about here, but I'm going to only show you how to buy a call option right now. Okay, so if you're seeing this, so the current market, so as for the, if I want to buy one ETH options trading, options contract, and you will say the price, current market price is 0.0662 ETH, right? But the price will be floating from time to time. But anyway, but you will say that if you click this buy, and you will say, like some, I'm not going to click in because I have bosses for options trading, options contract right now. But you know what I mean, right? So that means if I buy one ETH, it means I need to cost like approximately, if you do like some limit order, and approximately will cost me like 0.068 ETH to buy these options. And one single options, I assume one single ETH option will control one ETH. So, but I'm not gonna buy it because it will cost me approximately $226, which is pretty costly at this time. So it's not a good time to buy it right now, because also the market implied volatility is pretty high. I think the 70% is pretty high. I feel like the normal average ETH market implied volatility is 70%. And sometimes at some point it's 90% is pretty high, and sometimes it's like 40% or 50% at some like low level, historically low level. So I don't feel it's a good time to buy it right now, because the implied volatility is not that low at this point. Okay, so anyway, but if but I recommend, if you don't have enough ETH, don't click the sell. Don't click the sell. It's not a good time to sell right now. Okay, I'm going to tell you how to do options. I'm sorry. I'm going to how to do. Let me explain the sell options. Sorry. Don't click sell option, because you need to have like some liquidation problem if you sell it. But most of the institutions like selling options, because they have like, they can immediately get like some premium of options contract. But as for the retail investor, unless you have enough enough capital in your in your account, I don't recommend you do sell side at this moment, unless some you can predict that there's no huge things happening in the future, like the price will be pretty normal, or pretty stable in the near future. You can do like sell side, but if the volatility is pretty high in this time, I feel like being a selling side is pretty risky. Okay. Anyway, okay. What if you are going to want to buy put options, and you assume like at some point so for example, like 200 so at some point you assume the price will be down like below I don't know, probably you can assume like 1 month later, you assume the price will be down like 0.0370. Oh, sorry, will be below $3,000. In that case, if you see this right now, because you actually can buy it. Let me say how much I need to cost. It's like $122, and the market price is, if you buy a sell option for ETH, and it cost me like 0.0375 75 ETH. I'm not quite sure because I'm not sure ETH will be below $3,000 in 1 month later. I don't know. I'm not going to buy these options because I have no idea. I have no idea how ETH price will be looks like in 1 month. Someone say ETH will be up. Someone say ETH will be down because the Japan will probably the Japan are considering raise their interest rates, and the Federal Reserve of the US are not considering cutting more rates in 2025. So I don't know. You can guess, but I'm going to tell you like how to read this. So in this case, if you can see the delta, so the delta for put option. By the way, we have already explained the marketing implied volatility and gamma and theta and vega. They're quite very similar to put option we have already explained. But as for delta, it's quite opposite to the call options delta. For call options delta, the delta is larger than 0 all the time. But for put option, the delta is always below than 0, which means as the spot price goes up by $1, and theoretically, if I'm buy side of the sell, if I'm the buy side of the put option, and then my purchased put option price will be down like by $0.29. So it's quite reasonable, right? Because you're buy side of the put options, right? So as for put option, so you bet you are predicting the price will be down in the future, right? But if the price is go up and as for the buy side of the selling as for the buy side of the put options, as for the investors, their options will be less and less valuable in the near future, right? Because the actual price of the spot price is totally against your prediction, right? So it's pretty reasonable. Okay, so that's a way I'm going. I talked how to buy this, and invite some time. Like in the next video, I'm going to try to tell you how to be a sell side, but once again, as for the selling side, it's pretty risky. Only I feel like some institutions will do this, and as for retailer investors, I don't recommend to be a sell side unless you have enough capital in your account. Okay. Okay. Just it, and that's some material I want to share. And have a good day.